You're listening to The Practical Wealth Show with Curtis May.
Hey everybody, so Curtis May back. Happy New Year as you listen to this. It should be 2019, so I'm excited about having a great year. And so welcome to The Practical Wealth Show. So I have, today's show is really all about practical behavioral finance. And I have a special guest today, Mr. David Keller. And so let me tell you a little bit about David. David's the president and chief strategist at Sierra Alpha Research, a boutique investment research firm focused on managing risks through market awareness, and author of the blog Market Misbehavior. David calls himself the right brain person in a left brain industry. That's great. We'll talk about that. And he prides himself on his ability to bridge the gap between academic and practical finance. With Sierra Alpha, David combines the strengths of technical analysis, behavioral finance, and data visualizations to identify investment opportunities for active investors and enrich relationships between advisors and clients. So he uses his blog to teach, I like that, education, readers about investing through metaphors, most frequently paralleling the process to aviation and flying. So we'll talk about that. And the blog platform also provides him the opportunity to make observations on market psychology. In addition to this, David is featured contributor to stockcharts.com, where he authors a column called The Mindful Investor. And so, David, say hi out to our listeners out there.
Curtis, it's a pleasure to join you and everyone. Really happy to be here. And yeah, looking forward to a great conversation.
Yes, me too. So, David, what didn't I tell him? You know, I see you have an aviation background. How's all this stuff work together for you?
Yeah, so, I got into the industry in sort of a random way. I studied the liberal arts in college and then started at a firm in New York called Bloomberg, where I spent a lot of my time working with institutional investors. And I've always found through my 18 years in the financial industry that I'm always looking for other disciplines, other activities, and I always find myself relating it back to investing. And when you and I were talking earlier, I mentioned that for me, investing is all, and proper investing is all about making better decisions. And I find like all across our lives, we're challenged with decisions that we need to make and making good decisions and not letting our emotions overtake them. And so for me, comparing it to something like flying is all about what lessons can I learn from that activity and how can that help me to make a better decision about my finances. And that's where I found the most fulfillment. And I've hopefully been able to help people the most with that way too.
Okay, that's awesome. One of my mentors, Nelson Nash, we teach a strategy called Infinite Banking, is an aviator. So he uses a lot of flight analogies in some of his conversations with us. So that's, I have this thing also. I read about this in a newsletter. This is a while ago, and it was talking about, I got to find it because this is a good episode, a good article that I should talk about. But it talks about, it equates financial, it was equating financial to aviation in the sense that all systems in an airplane, there's a redundancy set up where there's a system and there's a backup system. So a plane could fly with and do everything it does with two engines, it could do with one.
That's exactly right. And what I've often taught people is the whole process of a pre-flight checklist. You basically go around and check 100+ different procedures to make sure that they work flawlessly. And it's all about redundancy. So you can power the plane up through multiple ways. If you lose power, you have a couple different ways of getting it back. And there's such a discipline to it that by the time you actually get up in the air, you feel fairly confident that it's going to stay flying, which is important because it's all about having the confidence to not worry about what if something goes wrong, because if it does, you have the process and you know what you need to do. And as a result, it's a lot like a market moving against you or an investment going poorly or, the challenges of diversification. You don't have to worry because you have a good backup plan. You have a good emergency plan in place.
I like that. So look at, I was just watching this morning, CNBC, they're talking about, the Russell 2000, this and that, and we're going, into a bear market. I'm not sure we ever came out of it, but that's philosophy. And but so let's bring that into behavioral finance and the relevance of what you mean by that and the relevance to investors. And so this is, and let me just create a context. So guys, I teach that there's 4 asset classes: business, real estate, paper, assets, and commodities: oil, gas, gold, silver. So right now we're talking about the asset class called paper, right? Mm-hmm. Dealing with the equity market. So we're going to have a discussion relative to that, so you know where we are on our continuum.
Yeah, so I think, it's funny you mentioned that, entering a bear market, and there's this sort of arbitrary amount of the market loses 20% and then it's officially labeled a bear market. But I think from a behavioral perspective, bear cycles and bearish behavior is what will come out well in advance of that and well after that. So it's sort of an arbitrary number. I think seeing the behavior, seeing the psychology or the sentiment of investors and what decisions they're making, that's what tells you whether or not the market is in a bullish or bearish phase. So for me, well before the market gets to 20% down off of its highs, for the Russell 2000, with a lot of other markets as well, and global markets are even further beyond that, you get a sense of panic, you get a sense of fear, you get a sense of when the market rallies, there's a rush to sort of, to get out and sell further into that. And you see that from the chart of how the market continues in a stepwise motion further and further down. So overall, what I would say is from a behavioral perspective, you can get a sense, not from the news headlines, but just from the markets themselves, what they're telling you. And I don't think a percent move is the line in the sand. It's more just seeing the behavior of, how the market feels and how it fluctuates day to day. But I would say that this is, when the market does what it has done in the last 12 months, which is, a very choppy, increased volatility, lack of direction. And if there is a direction, it's more down than up. This is when you want to be more, disciplined and less emotional and, focus on, the trends and the benefits of diversification as opposed to trying to chase performance, which is probably one of the worst things that you can do at this point.
Right. We always talk about, we talked about this before we started calling, is that most people, we used to call it, when I did equities, was rear view mirror investing. So they're always chasing last year's winner.
That's right.
So even when markets go up, most people still lose money because they're.
Yeah, in general, people tend to time that decision, and market timing in terms of identifying that based on past performance is actually very, very difficult to do. And in general, the whole,
if not impossible, right?
That's right. And the whole idea of ranking funds or ranking assets based on recent performance and using that as what to get into, in general, you'd be better off doing the opposite, especially when you think of more of like a 3 to 5 year horizon, which is a lot of funds. That's where they're going to report 3 to 5 year performance. In general, you're better off betting on the funds that have underperformed over those time periods because there's a cyclical nature to the markets. So in general, rear view mirror investing tends to make people feel better than the performance should actually make them feel, if that makes sense. It makes us feel better psychologically because we feel like we're betting on what's working. But over that time frame, you're actually hurting yourself by focusing too much on that, that performance over that sort of time frame.
Yeah, I think you worry yourself to death. It's ultimately what is your goal, and how do you get from point A to point B, and how does this help you do that? So I really love the flight analogy, because I think that you've got to, what are the gauges that you're looking at? How do you monitor it? You're always off course. So you always need to be making, from the time the plane takes off, it's off course, and you always have to be making course corrections because you got to account for atmosphere. And I told you, I've read it a little bit,
You're talking like an aviator,
right?
Well
right. So listen, don't be fooled. I'm on the edge of my lack of knowledge. I'm right there on the edge. So I'm going to stop.
No, but it's funny. A lot of the comparisons that I make now, it came from when I was first learning to fly a couple years ago. My flight instructor, he would trade stocks when he wasn't up in the air. He would do it as a hobby. And so we, in those stretches of, once you get up in the air and you're flying, there's little maintenance things to do, but you're sort of looking out and enjoying the view and talking with your who's in the cockpit with you. And we would chat about the markets. And it was funny how many comparisons we would make, not just on the discipline and the process of flying, but also just things, a lot of the words we use to describe the markets come from aviation. So it's taking off, it's crashing, a glide path. I mean, these are all, common aviation terms because it describes stocks and markets so well. But there is certainly, my firm, Sierra Alpha Research, that's slang for, Sierra Alpha is slang for situational awareness, which as an aviator is the idea that you're looking out and you have an awareness of what's happening around you. Because the worst thing that can happen is you fly into a situation and you don't have an awareness. And that's when you hit the ground, you hit an obstruction, a mountain, you hit another airplane, you're in the wrong airspace, and all of those things can happen if you don't have a proper awareness. So for me, it's about teaching a market awareness and understanding what is happening around you from an investment perspective, making sure that you're leaning towards the things that are starting to work and leaning away from the things that are starting not to. And as you mentioned, it's all about course correction. It's all about those little incremental changes that'll help you be on a path to performance success and away from getting hurt by not being aware of what's really dragging your performance.
Can you give me an example of something when you say situational awareness that people could, should be thinking about and integrating that into their
Sure. Yeah, so absolutely. So a situational awareness, it's about understanding all the different opportunities. I tend to describe it to my advisor clients of all the different levers that you can pull for your portfolio or for your clients' portfolios. And so as an example, from a sector perspective, if you think about the 11 main S&P sectors and how they rotate, certain times in the last couple of years, things like utilities or real estate or consumer staples have been the best performing sector. But we don't tend to think about that because we're so focused on the FANG trade or the technology, consumer discretionary, industrials, those types of groups. We're so focused on the financials and the big banks and what they're doing. So a situational awareness means you need to look at all of those sectors and see how they're performing. So I've worked on some data visualization tools to help you see, here's the entire market. Here are all the sectors and what they're doing. Yep. Let's focus on where the opportunities are and get there. And a lot of times you'll find it's in an area where you would not normally be comfortable looking at. You wouldn't normally think of utilities as a good bet, but in certain parts of the last 12 months, that's been the best sector to be in. So it starts from an informational standpoint where you get all of the right data, and then you can make an informed decision about where you want to be focused. And that's not just on sectors, that can be on asset classes. You talked about, I always joke, paper versus rocks, is it the paper assets or the hard assets like commodities, gold and things, just coming up, having the right information to understand where that's going can be really, really helpful to make sure you don't miss opportunities.
One of the things I hear is that, you're not, what is it, Gordon Gekko? I don't throw darts against the wall. I need, I need information, and, but it's really more so you need education. So to think, because there's a discipline to this, and see, one of the things I find, which is just a topic that's so interesting to me, is that people don't even open their statements, and if they're, especially mutual fund people or 401k people, but I think that you should know what's going on.
Yes. And it's so easy to not be aware. And that's when, something that has been working for the longest time starts not working, and you don't have the awareness that's happening. And I would say maybe a common example of that now is fixed income. So, we're coming out of a 30-year bull market in bonds, where it's 1980 to 2010, just fantastic, consistent performer. And all of a sudden, we've had this rotation of what I would argue an accumulation phase in fixed income to more of a sideways phase. And now we're entering a distribution phase, in the coming years of weaker bonds, higher rates, which means that a lot of people have been thinking of the fixed income portion of their portfolio as a savings account, something that consistently does well. And if we enter an environment where that's not the case, you have to open your statements and see that that's no longer happening, and then start to make decisions to change your allocations when appropriate. So I think that having that awareness, or you mentioned, it's as easy as opening up your statements and just being familiar with what's happened. Then you can make an informed decision about what might happen next, and bet on the probabilities of where you want to be.
Right. Or just if let's say you're in the equities and you've got, somebody that's a really advisor that, understands what's going on rather than just selling you a fund or whatever, more of a product pusher. You need to be able to have, good discussions like this. Yeah. Because I always tell people, look, it's your money. It's not their money. And It's and so what we do is we abdicate responsibility, and I think that that's not good stewardship, because I think the industry teaches you're not smart enough, you don't have the training, the temperament to personally manage your own money. You just explain a lot of stuff, charts and this and that, but if you're going to do it, you should take a stab at understanding at least some basic stuff, though, because I would tell people, look, you go to work for money. Does it make sense to learn how money works?
Yeah. No, it's true. And I would say on both sides, I think a good advisor has a good awareness of what's happening so they can inform and educate and have a rich discussion with their clients. But I think also as individuals, part of managing your own finance as well is having an awareness of what's going on and being able to ask the right questions. And when you're both better informed, the relationship is better, the discussion is richer.
Yeah, discussions are better. That's right. Exactly.
It's exactly right. And way too often it's a one-way discussion, and then that's not really helping either of you, because then and then again, you don't want to be questioning what everyone's motivations are. You come together, have a good discussion, and then you're very comfortable. You have the peace of mind of knowing that where you're positioned in the right place for where you're at. But that starts with being informed about what's going on around you, for sure.
Would you say that, like with your work at Sierra Alpha, is it more, so you work with advisors, but is it more people that are more individual, who buy individual stocks versus managed money, or mutual funds, or both? Like, where do you have more control? Where do you
Sure. So, yeah, absolutely. So I work with active investors, and that goes from, high net worth individuals making decisions about, actively investing their own, portions of their own capital, all the way to institutional investors at the larger money management firms, managing, billions of dollars in mutual funds or in separately managed accounts, and sort of everyone in between. And so for some of them, it's an asset allocation decision. So it's thinking broader about, how to allocate through stocks, bonds, commodities, or, the descriptions you had, I think were spot on in terms of the four places you could go, the levers you could pull. But for some, it's getting into sector rotation, it's getting into individual stocks. And so my discipline, using behavioral finance and technical analysis, which is really using charts to understand trends and momentum behind asset prices, that's designed to work across asset classes. So it's a great way to think about asset allocation, but also sector rotation. But when you get into individual stocks, it's a great way to differentiate what's working and what isn't. And again, when you get into individual stocks, there are so many potential investment decisions you could be making. There's so many different markets, there's so many different industries and stocks. And so the ability to screen for good ideas or filter through all the noise to identify the most actionable movements, that's I think one of the biggest challenges. And so that's with my clients that work on individual names, that's where we spend a lot of our time.
Would you say, can you speak to the difference between, you talked about charts or technical analysis and value investing? Can you speak to that?
Yeah, so what I've learned over my career is there are so many different ways to succeed. There's no one way to manage money that's going to always work. And I've met exceptionally talented value investors, and with my time at Fidelity, for sure, I met people that were fantastic value investors that consistently did well. And I met growth investors who are more trend followers that did very well also. So I don't think there's one way to do it. I think coming up with your own system, your own plan, and then staying true to it, staying disciplined is probably the number one thing you can do. And that's where you work with, an advisor to make sure that you're in the right place for that. But I would say that, in general, there's two ways that I found looking at market activity, looking at the data. You can bet on mean reversion, which is sort of a value proposition. I want to buy when things are undervalued and sell when things are overvalued, or buy when things are cheap and sell when they're rich. Or the opposite is more of a trend following approach, which is you want to buy what's working and you want to sell what's not working and bet on the persistence of trends. And the reason why both of those can work is because the timeframes are a little different. So if you look at the data, especially equity data over multiple decades, over a short-term time frame, which is sort of the couple weeks to a couple months or even shorter, markets tend to mean revert, meaning they tend to fluctuate and go weaker to stronger. So you're better off in that time frame buying weakness and selling strength, or buy low, sell high in general. But if you're looking at, a couple months to a couple years, sort of that 1 year-ish time frame or around there, you're better off following trends. You're better off following what's working and avoiding what's not working, and betting on those trends to persist over that time frame. And so in general, you can bet on value on a shorter term and bet on growth or more growing stocks over the longer term, and that those both actually coincide very well.
Okay. I used to think like this, or this is what I was told. I want to know really how true this is today, because so when you buy stock, you're buying a share of a company. And so you want to look, I think it's more so with individual stocks, but you want to look at the company. If you see like Buffett, everybody, he calls Coca-Cola, what is it, a toll bridge? Like everybody, regardless of inflation, is going to drink Coke. So if the business is running well and they've got good earnings, I want to hold that company for a long time. Is that value investing, and how valid of a strategy is that? Well, I guess you said they're both valid, but can you win that way?
Yeah, right. So you're getting more to a long-term process, right? More of a long-term, more of a buy and hold kind of strategy, which is buying when things are undervalued and then holding them for the longer term. And in general, if your time horizon is long enough, that has consistently worked. And the easy way to see that is just look at the long-term earnings growth in equities. In the S&P 500, for example, it's consistently gained value over time. And stocks over the long term have been a consistent source of value, and probably the best place to be as an individual investor over the long term. The challenge is your investment horizon. So if you enter that trend at the wrong time, so if you started as an investor in 1929, or if you started in 1971, right? There are times when it would have taken you quite a long time to start to gain on that. But if your horizon's long enough, it's consistently pretty good. So in general, what I found is it's less if that strategy works, but it's more how much attention can you pay to your investments. So, if you want to bet on shorter term fluctuations, you have to be able to pay more closer attention to what's happening. Right. Because you're betting on shorter term movements, you have to be aware of the volatility. If you're not able to focus on that, then you either need to have someone who can do that for you, or you need to be betting on the longer term trends that you're suggesting, because otherwise you're just going to be on the wrong side of things, and it's just going to hurt your returns. So that's more of it. It's more of the attention that you and the priority you can make on following your investments, and then either you or someone that you trust being able to watch it on the time frame that you need. Otherwise, you're just opening yourself up to some pretty bad returns, unfortunately. Okay,
that's a good point. So what I'm hearing is that if you're going to be active, it's because in looking at technical and trading and this, you have to pay attention to it. And the volatility is really, the opportunity to make money is within the volatility, especially if you're more doing technical stuff, following the performance. If the volatility is how you make money, you just because markets move up, they move down, they move sideways. So if you're a paper investor, and if you understand what Dave's talking about, you'll make money in all three.
That's exactly right. So if you're more of an active investor, volatility is a good thing. It's not a bad thing. Volatility is a bad thing from a behavioral perspective, mainly because it causes us to make decisions that are not in line with our overall process or with our goals, right? So step one is deciding, where you want to go with your investments. And then step two is having a disciplined process to try and get there. And one of the biggest mistakes I see investors make from a behavioral perspective is having a longer term time frame, but reacting to short term market fluctuations.
Yes.
Number one by far. And there are a lot of there's been tons of academic research that's shown why we do that. And as an example of that, one of them is called myopic loss aversion. And very quickly, loss aversion means we don't like to lose money. And the myopic part means short-termism, like we tend to react short-term. So faced with the prospect of losing money, we tend to act in way too short-term of a time frame. And again, academic research has shown that we do that not just with our finances, but with anything. Right. So the problem is you're trying to bet on, as an example, as a long-term investor, you're trying to, benefit on long-term returns, but then you're reacting to day-to-day movements, and not just, stock market fluctuations, gains and losses, but you're reacting to Trump headlines and, China trade issues and geopolitical challenges and all of that. And a lot of times that's just noise that makes the short-term fluctuations. Longer-term trends are a combination of all of that noise. So you want to make sure that you're operating on the time frame you want to. And then again, way too often we overreact to short-term fluctuations that just hurt. All it does is it churns your portfolio. It raises your trading costs with no real benefit to yourself. Right.
Exactly. Because all that costs money and taxes because, you're pretty much investing for capital gains, right? So every time you have a gain, that's not every time, but, at the end of the year, that's a taxable event. Plus you got your fees. So you have to pay attention. But I like what you're saying in terms of control. The key, you have to educate yourself. Because it's your money. I tell people, look, I want you to read a book a month on money so that when we meet this time next year and do our review, our conversations are better because you have better questions. I mean, certain stuff you're not even ready to talk about yet.
That's
because,
right.
It's like, hey, ask me call me, you have any questions? Like, in saying that in finance, I tell people, you might as well say, look, call me anytime and any questions you want to know about nuclear physics. Right?
Right?
It's basically the same thing.
That's right. And I would say that, getting back to the comment about short-termism, I would say, bringing it back to when you're flying an airplane, that's where it hit me how much we do that. And also the challenge is when the market becomes more volatile, we tend to get much more emotional about it because we're seeing the gains and losses and feeling them, physically you're feeling the sensations of the gains and losses. And the way I would think of it is when, I've luckily not been in an airplane when we've had an emergency event, but you train for them, methodically. And so you often recreate the situation of a stall or an engine loss or something like that, just so you can do it. And if you think about it, if you're flying an airplane and the engine goes out, the last thing you want to do is panic and start, scrambling around and just trying things, right? What happens is by the end of your training, you have a very disciplined, emotionless way of reacting to it. Your plane's lost power, no problem. I check 1, 2, 3, 4, 5, 6, 7, and it's this checklist that is so ingrained in your head. You do it without thinking, and as a result, you're not affected by the emotional reaction to, oh no, the plane's losing power. You just think of, okay, this is an event that has happened. This is the way that I'm going to address that and put myself in a position to succeed, even in a difficult environment. And, most of the time, the process that you've learned will correct the issue and you'll be just fine. So that's the way that you want to strive to do it, is not use your emotions as a catalyst to making a poor decision with your money. You want to get the information around you, be informed, ask the right questions, and then, as much as possible, make an emotionless decision, a disciplined decision about what you need to do.
When you said we were talking before, I was used to do teachers' retirement plans in a school district. And so we used to do the 403Bs. And so this was like 1999, and he was a middle school teacher, and he had this little pager that had like the NASDAQ and all this stuff on it. He would check it every time I was in the room. I'd come see him, and the market's down, and it was like something in his stuff wasn't even in, but he stressed himself out. And then one day the market was down. It was like, you got a lot of nerves showing your face around here today. I was like, what did I do? I said, if you're worried about stuff, you don't even own any of this stuff. Calm down. Yeah. And so how can investors use technical analysis and behavioral finance to manage I don't know if you can mitigate risk, but let's say manage the risk into their portfolios? What should they be thinking about, and maybe some of the things they would learn as they, if they're, paper investors, and they subscribe to your blog? What are types of things that you help people understand?
Yeah, it's a great question, and I would say that it's not going to work if you ask yourself, how can I eliminate risk? It's never going to happen, right? There's always risk inherent in investing, and but I would just remind you that where there's risk, there's opportunity, right? You're basically paid as an investor to take risks and reap the benefits of making good decisions. So I think risk is there, but you want to minimize the impact and minimize your exposure to certain risks. And for me, I found that a being very comfortable with behavioral finance, which is some of the things we talked about, just taking emotions out of the decision, having a disciplined process is really important. And for me, the practical toolkit that I've used to take advantage of or minimize those behavioral implications on my own decision is technical analysis, which is essentially looking at charts of stocks and commodities and interest rates and currencies and understanding what's happened. And so that, for me, I would say when I think about having a situational awareness or an awareness of what's happening around you, looking at a series of charts that show you the 11 S&P sectors and what they're doing, or showing you how stocks versus bonds versus gold have performed over time, that's where you start to make a more informed decision, or at least have a more informed discussion about what's happening. So for me, technical analysis is a combination of having a disciplined process. So I have trend following models that I've designed, which use moving averages, which is essentially just smoothing out, getting rid of the noise and just looking at long-term trends in different assets. You have a trend following process that just tells you, no emotion, no subjective decision. It just tells you, is this market going up or down? Should I be bullish or bearish on this group of stocks or this commodity or this, bond or whatever it is? And that's the starting point. And then from there, there's a lot of tools you can use to understand price momentum. So right now in the US stock market, we've had this, really volatile, really confusing December where the market rallied aggressively on days when it's normally sort of a sideways, choppy, sort of sleepy market. It was very sort of active and moved a lot. Going into the new year here where, the question is how we start after this volatile December, how do we go on? And for me, charts are the way that you understand how those prices are evolving and how they sort of progress. And make sure, as I mentioned, make sure that you're not missing an opportunity. The best opportunity in 2019 is something that will evolve. And for the people that recognize it and see as the trends start to emerge, those are the ones that are going to be in the right places for it. And I think the people that miss it are the ones that don't have an awareness of what's moving, what's gaining and what's weakening over time.
That's brilliant. So what do you see as you look at stuff? So as we record this is January 2019. Applying those, the concepts of behavioral finance and, having a bigger picture view of, one of the things I got frustrated with when I was a rep is that I was going through markets, but I didn't understand why they were going up and down. You know what I mean? And that frustrated me because I didn't want that pat answer I would get from my wholesalers. Oh, market's going to come back. I needed to know what the hell was going on, and and I'm a nerd. So I'm like a financial nerd. So if you get me started, I will figure some stuff because, I started studying the Fed and I started to understand. So all of a sudden I started to understand those charts, those charts that, that on the bottom line, or I remember this is a while ago and I started to understand how the Fed works. And this is where you start educating and you kind of can filter out the noise. And I remember they said, well, this is Bernanke was in office. He said, well, the fluctuations in the market are caused by speculators, something going on with Libya, some other country, and about the price fluctuation of oil in the economy. And I was like, wait a minute, 90% of our oil comes from not Mexico. Yeah, Canada and Mexico. Or something like that,
Yeah.
And so you can see through the spin and have a clear picture as you educate yourself. And I would say that applies to the equity market in paper. So I want to get that out. But going forward, as you see all this stuff that's going around, what's your feeling?
Yeah, so I mean, overall, in terms of equity, what you're calling paper assets, it definitely feels bearish to me. It feels weaker versus stronger, for a number of reasons. Some of the signals that I saw from a technical perspective, sort of middle to late last year, 2018, where you saw weakening breadth and weakening sentiment. And weakening market breadth, there's a lot of ways to measure it, but it would be something like advancers versus decliners. So out of a big group of stocks, the S&P 500 or something like that, how many stocks are closing up on the day versus down on the day? And if you look at that over time, you start to see trends that even when the market is going higher, more stocks are actually trading lower. And that would happen when smaller companies, when more higher beta, more riskier companies are starting to sell off. It's the big conservative, Johnson & Johnson types of companies that are still holding up. But that overall doesn't tend to be a very encouraging long-term sign. And that's what we sort of saw in the middle to late 2018. So that's when I sort of turned negative on from a breadth and sentiment standpoint, was you just saw a lot of stocks starting to sell off before the overall market. And at this point in early January of 2019, I don't really see that alleviating. And I would say the other way that I would measure it as a technician, you call it Dow theory, and it comes from Charles Dow, who was the father of technical analysis, early 1900s, created this system of looking at stocks as an index and how to measure trends and all of these different things that we now take for granted. And one of the things he said is that it's so simple. An uptrend is a series of higher highs and higher lows, and a downtrend is a series of lower lows and lower highs. So if you want to know what a market is doing, look at a chart and just see, are the high prices getting higher or are the low prices getting lower? And one of those two things is going to be happening. And right now, if you look at a chart of the S&P 500, you'll see a clear pattern of lower lows and lower highs, meaning it's going in a stepwise motion downwards. And until that stops happening, the market is in a downtrend, and you want to be lightening up on equity exposure, or looking for places that are still going to do well in that environment, which are more conservative things like consumer staples, utilities, real estate, more sort of lower beta but higher dividend paying types of markets. So from a technical perspective, the market looks weaker here, and until we see some sort of appreciations, until you see things like technology and consumer discretionary recovering, and you just haven't seen that yet.
Right. And see, that's the thing. You got to understand if you know what's going on, you know what to do. And so the things that affect other things negatively, somebody's on the other side of the trade that helps.
That's right.
And you know what I mean? And so you have to have take a 50,000 foot view. It's like, okay, if we have inflation, that helps this sector, and if consumer sentiment is down, that hurts retail, but it helps this, and so you kind of can't just, fall in love with one thing or one stock or one industry. Wow, I know more about this stuff than I thought. All right. So I'm hearing myself go, hey, a question to, like, one of the things that I see a lot with a lot of the stock prices were due to companies doing a lot of financial engineering, buying debt. And, I never really understood why would they buy back their stock. I didn't see how that helped the company at all, but it did help their stock price. But would you, so when you see that, how do you account for that in your technical analysis? So like debt is the price of the money that they were borrowing is going up. So now they have to service all this debt they captured. Does that factor into analysis or your analysis also?
So I would say this, that there's been a number of tailwinds in recent years for equity prices, and one of the big ones is not just buying back debt but buying back stock. So there's less supply now than there was a couple of years ago. In terms of, there's just less stocks out there because companies have been buying back shares. So, and so what that does is it's a simple supply and demand economics 101. There is less stock out there for investors to buy, and as a result, the value will tend to appreciate more than to depreciate, in a vacuum. Right. And so what's happened is that's been one of the things. And again, it's not in a vacuum. There's a lot of things going on. But I would say companies buying back shares has been key. Also, just the general supply of equity in the secondary market. And what I mean is, so many companies have gone private. And private equity has been a growing part of the industry and a growing influencer in the industry, which means it's not like the average company at this point, especially in technology, is going public, and that's sort of their big coming out. It's a private equity experience, and as a result, there's less companies less stock out there for you to buy, and those two things combined, companies buying back shares and companies going private through some sort of buyout, limits the number of equities out there, which in general limits the supply and should increase the prices. And so those are two sort of tailwinds that we've seen where, there's a lot of things suggesting we're sort of at the end of that. That's not an unlimited process. Right. And so when that tailwind subsides, then all of a sudden, you wonder what's the next thing that could
what's the next step? Yeah.
That's right. I'm not sure what that is. I would also say in reference to your earlier comment, and especially about short-term movements, right now, especially with Twitter and a president who's active on Twitter, a lot of those things, I would say, coming from an institutional background, working with professional investors, the whole Trump effect is still very much an unknown, and it catches everyone off guard, not just individuals. And it's very easy to overreact to a tweet or to an announcement, a headline. And that's happened for forever. But now we're at a point with, the president tweeting so often. It's very much an unknown. And I would say that more than ever, what I find the benefit of looking at charts is you're not looking at news headlines or tweets or anything like that. You're looking at price, and price can't be restated. Price can't be taken back or edited. It is what it is. That is where two people came together and traded or two machines came together and traded a stock at a certain point. So looking at that, you are in some ways filtering out the noise and looking at the trends and looking at the behavior, the sentiment of all the other investors around you. So I would say now more than ever, it's really important to try and filter out the noise and look at what's actually happening.
That's awesome. What would you, if somebody wants to learn how to think about this better, do you have any favorite, in addition to your blog, we want to talk about that,
Sure.
Books, newsletters, that you read that, and, I'm thinking about, as I think about this, because I'm wondering how this is the question I had before, how this helps the 401k person or my IRA that I roll over, and I'm here at this XYZ, I'm Vanguard, Fidelity, not to, disparage any of that, because I don't mean it, I'm just naming them because everybody knows who they are. Would learning about this stuff help me?
Yeah, no, that's a great question. So a couple things. I would say in terms of books, there's two that I would throw out there. And I did I edited a book about 10 years ago, and I would definitely not recommend it for what you're suggesting. It was more of an advanced book on technical, on thinking of price trends. So that can come down the road for people. But the two that I would say, if this sort of thought process seems interesting, you want to know how to get ahead of some of the behavioral biases that are going to impact your decisions. Two things I would say. One is a book by James Montier called Behavioural Investor, and his last name is Montier, Montier. And the book Behavioural Investor talks a lot about the different biases that impact your decision. It's things like confirmation bias and the rear view mirror effect and all these things that you sense that you're making poor decisions. This will explain why and help you get ahead of it. Which I think
that's awesome. Yep.
The second one I would say is a classic investing book by William O'Neill called How to Make Money in Stocks. And William O'Neill, he started Investors Business Daily, and which is now a weekly periodical, but a pretty rich website that understands the relationship between fundamental analysis and technical analysis. Or what I mean is the relationship between the companies, the earnings, the profits, and all that, and the stocks themselves, the trends, the relative performance, the institutional support, and marrying the two in what I'd call a fusion approach, which I would say if you're looking at individual equities, that's how you should think about the two. Think about the companies and the stocks as two very important but different points. And he does a good job of explaining how to look at those and a process for picking stocks as a result. And then online, my blog, I certainly would welcome people to look at. The other thing I would say is stockcharts.com is a website I've been involved with, and I write a column there called The Mindful Investor, where you apply mindfulness techniques, having an awareness of the now and calmly approaching things into investing. But a number of my fellow contributors do a really good job of explaining where the movements are, how to think of things from a big picture perspective, and being aware of movements in different markets. And they do a really good job. And it's people like John Murphy and Martin Pring and Tom Bowley and many other really, really savvy traders and investors. So I'd point people there as well.
Okay. All right. So we'll put the links to the books and the websites, David's blog in the show notes. I actually could talk about this all day long, but we're respectful of your time. I really appreciate you coming on and sharing your knowledge. Guys, I just try to hang out with smart people, right?
You mentioned that earlier, Curtis. And again, I am humbled and thrilled that you would put me in that bucket. But no, this has been a pleasure. It's a subject that I'm passionate about, and I truly feel that investors would be better served by being more aware of some of these concepts. So, I hope people have found this to be helpful, and I certainly enjoyed it.
Yeah, me too. So I found it to be helpful. So I got half page of notes. So y'all can mess around if you want to. You get off the treadmill and get your pen out. Okay. Listen, David Keller, thank you so much for coming on the Practical Wealth Show. I truly enjoyed it, and hopefully we can follow this up, because I think it's going to be a bumpy ride. So maybe in 6 months we can get back on again and keep them off the bridge, like pull them off the ledge.
We might have a whole new set of behavioral challenges to address, I'm sure. But no, happy to do it. I look forward to keeping the conversation going, Curtis.
All right. Thanks so much. So, hey, guys, I hope you enjoyed this. I want you to go out there and, have a prosperous 2019. And thanks for listening to another great episode of the Practical Wealth Show. Thank you.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.